Good morning, everyone. Today we're going to continue our discussion on Chapter 10's overhead section, overhead variances. We'll just review our time frame, what's left. We're fast approaching the end here, guys. That's awesome. I am looking to wrap up our discussion today on Chapter 10. I will also get started on Chapter 14 today, and looking at finishing up my discussions on next week, Monday the 6th, with our exam being on that Wednesday the 8th. And after the exam, we're done. So we're about a week ahead of schedule, so that's awesome. Any question on due dates, requirements, before we get started here? All right, let's take a look then at a couple problems this morning. 59 and 60 we are on schedule to do today. I have a template here. The first one is pretty straightforward. Has a lot of the information we can just plug into our templates. So we'll do that first. 60 is a little more involved, and that's why I want to touch on that one. Remember that problem 74 is our TSA problem. So work on that. If I probably will give you time again today to work on your Cengage assignments. So my discussion will not be the full, 3 hours today. We'll certainly wrap up at least an hour before for you to work on your CNOW assignments. So starting on problem 59, go ahead. Does anybody need a template? Let me know. I'm going to stop my recording here just so that I can have you start filling out the template on your own. Okay, guys. I think I want to start with the SVOR. Well, let's start with the standard fixed overhead rate down here. When we're looking at a standard fixed overhead rate, we have to look for budget numbers. Budgeted dollars, budgeted level of hours. So what did it say about our fixed overhead? What was the budget amount?
832,500.
Yes, 832, Teresa. Where does this 832 also go?
The budget FOH.
Yep, right here in our center. So this 832, which is used to come up with our standard fixed overhead rate, that 832 is the same number that sits in the center here. One and the same number. So that's what we budget for fixed overhead. Now, fixed overhead again is our rent, our salaries, our depreciation amounts, right, all lumped together. And that total is $832,500 for the coming year. How do I get this bottom number, though? How many units did we plan to make?
600,000.
600,000. Does everybody see that?
Mm-hmm.
But that's units. My denominator has to be labor hours. So I'm going to have to multiply this by some number or some rate. What's the rate?
75.
0.75, right?
Mm-hmm.
3/4 of an hour. So that will convert my units to direct labor hours. That's the goal here. Because that's our bottom number. That's going to be our bottom number here. So 3/4 of 600 is 450, right? So that's our bottom number here, 450. Budgeted, right?
Mm-hmm.
Direct labor hours. So E, what's my rate then?
1.85.
So that's what I'm gonna put over here. 1.85. So that's kind of how it's all linked together. Any thoughts on that? Any questions? Okay. Nobody knows that I did this wrong.
It should be in the SFOR.
Yeah. Why did I put it over there?
I don't know. Because it's Monday.
It's Monday. Ooh. That look better? Uh-oh, I got questions? Yeah, Sam, I was getting there. Thank you. Yeah, it goes in the SFOR. Because I wanted to do this. I wanted to get, how do I get this number here, the SH then?
The actual we made? times
Actual we
salary.
made, yep. Very similar to what we did in direct materials.
Mhm.
How many did we actually make?
500,000. 500,094. 594.
594,000.
Can't. It's Monday.
And we gotta multiply it by what, Tom?
What's up, high?
By 0.75 standard. This is the standard rate. So we've done industrial studies. We've timed it out. We should be able to make one of these in 3/4 of an hour. And then how many allowed hours did we get then?
445,500.
And that's what goes up here. Up
Oh,
here.
Yeah.
445, 500. So how does our volume look? How does our volume variance? What's the direction going to be? Favorable or unfavorable?
Unfavorable.
It's going to be unfavorable. Why, Tom?
That's our actuals a lot higher than our French rate.
I'd like you to look at a different number. What number should we be looking for this volume? Don't look at the dollar amount. What number should we be looking at? What's volume a measurement of?
How many?
Quantity of units, right?
Mhm.
What did we plan to make in units?
600.
600. What did we actually make? 594. So we didn't quite hit our budgeted unit number.
Okay.
And again, that's a very important number to hit, is that 600,000, because all of our rates, all our standard rates are based on that 600,000. So our costs per unit are creeping up, and that's what we don't want. So we're looking at a total here in dollars of
824, 175.
So we put into WIP 824,175. We planned on 832. Unfavorable. How much then? It's like
8325.
how do we do on our spending variance? That's bad too.
31.
Also unfavorable, right?
Mhm.
Mhm.
We can add the two together. 11,425. Unfavorable. Remember also that this volume variance is a capacity measurement. They use that word also in the book. It's a capacity measurement. how well did we do with our operation? Could we have done more? And obviously, we could have done more units. Any thoughts on the fixed section? All right, let's go to the variable section. Again, let's start with the SVOR. This is a budget number that we determine at the beginning of the year. Our budgeted dollars are how much? They don't tell us directly. We have to figure it out. If our total was 1.77 million, of which 832 was fixed, what must be my variable then?
945.
I'm going to do this in a couple steps here. Let me get this first, Michelle. I'm going to subtract off the fixed from the total. And I can use the same hours, right? Budgeted hours were 450 based on 600,000 units. Again, this is a budget number. These are not actual data here. Okay, Michelle, I think I'm ready now.
So the top number then is, what did you say, 945?
Divided by the 450.
Which is $2.10.
Per direct labor hour. So every time these rates, these standard fixed overhead rates, are based on direct labor hours. 210 in this case. So let's see if I can get it in the right box. 210. Is everybody comfortable with getting this SVOR? The key is we gotta look for a budget number. SH is also the same as we have computed in our fixed. 445, 500. To Polly, do you have the amounts here? That's the middle box.
$936,636.
36?
Yeah.
So what's my spending variance to Polly? Should be 8,600.
Mm-hmm.
Which direction to Polly? Favorable or
Favorable.
favorable? So we did pretty good on our price, right? We probably didn't have as much waste or rework because again, we didn't use our indirect materials as much, so that's good. Good sign. Diane, what's my last number here?
935,550.
So my efficiency variance is
1050 unfavorable.
we can net the two together. What do we have left, Diane?
7550
And which direction?
unfavorable.
Yeah. So we're measuring here actual hours versus allowed hours. Not as efficient as we could have been, right, for the units that we did make. So time-wise, we didn't do as well as we probably should have, based on our standard 3/4 of an hour. So if I asked on the test, what dollar amount do I put in for variable overhead into work in process? What a dollar amount goes into work in process on the variable section here?
Last one.
The last one, right? And remember, our author uses the word applied. It's going into work in process inventory. Okay, my next question is, for variable overhead, what's my predetermined overhead rate? The 210, right? This 210, sometimes we call it the standard variable overhead rate. That's cool. But this is also known as the predetermined overhead rate. Obviously, it's the variable overhead rate, right? 210 is the variable overhead rate. The $1.85 is the fixed predetermined rate. $1.85 is the fixed predetermined rate. So watch for those, because I could say compute the predetermined rate, right? Compute the variable predetermined rate. Compute the fixed predetermined rate. That could be easily a multiple choice type question. And even if I give you actual numbers, right, you have to use budget numbers for those two computations. Watch for that. Watch for that. They know where students make mistakes. Who is responsible for all these variances? Every one of them. Production, right? So just watch for that multiple choice question as well. All right, let's do one more of these. I think we're warmed up. So here again, I'm going to stop my recording. The next problem I want you to do is problem 60, the one right below it. This problem 60, again, I like this problem. And I like using templates to solve this problem because you have to basically go backwards. So they give us the variance numbers, and then they want you to figure out questions 1 through 6. So start with the variance numbers and work your way backwards. I'm going to stop my recording. All right, I put up the variance amounts that were given. Where does the $6.36 go?
SVOR.
Yes, the SVOR. And the 11 goes to
Fixed overhead
the
rate.
6 fixed overhead rate here. Catherine, what is the standard hours allowed? What's the SH? $128.7? Everybody agrees. Yep, 143 were actually produced at 0.9. Excellent. Good job. All right, 128.7. And that we can use in both locations. And what Catherine did was we took the units, so the actual units, was the standard rate?
0.9.
0.9 hours to get 128.7. These are the allowed hours. This is what it should have taken us to make those units, those 143,000. Diane, what's this amount here, since I'm here? Oh,
Were you asking me?
yeah, Diane,
Oh,
I
I'm
said.
sorry. 818532.
Eight one eight five three two. So, Liz, now that I know this number, and I know the direction and variance, what must this box be then? It's unfavorable. Is that box bigger than or smaller than?
819804.
Everybody agree? 819804, if it's unfavorable, right? That means that this box is greater than this box, right? So by doing so, we have to add it. If this variance was favorable, I would be doing what? Subtracting it, right? Because that would mean that this box in the center is smaller than the outside box on the right. So now that I know this, Liz, what's my actual hours?
128900.
128,
900.
900? And doesn't that make sense that the actual hours are more than the allowed? That makes it unfavorable too, right? So that's kind of a proof then that we've done it in the correct direction. Teresa, let's do the other one. Same thing, we gotta take it and create, what's the actual overhead then?
829,000.
Again, we added because it's unfavorable. This box is greater than this box. All right, at the Poly, you're next. Oh no, you've already answered one. Ruby, are you home? Awesome. Can you tell me what the applied fixed overhead is? I'm over here on the right. What is this dollar amount? $1,415,700. Okay, Ruby, now that I know this number, what is going to be my budget number in the center? Knowing that it's a favorable volume variance. $1,386,000. Is that right, guys? Awesome. Good job, Ruby. We got agreement. And if it's unfavorable for the spending, what's the left number? $1,004,000 something? 1,410,000. Excellent. Perfect. So, not knowing our actual overheads, both variable and fixed, we can use our variances to get to that number using the templates. So that will be common on the test also. So be ready for those.
So for the bottom one, then the middle number should be less, the budgeted should be less than the applied for it to be favorable?
Correct. You're talking here?
Yeah.
Yes. If it's favorable. That's our only favorable one. So yeah, it will be less to the left than the right side. So let's answer the questions 1 through 6. And I'm going to change colors here. What's the answer to question number 1? Total applied fixed overhead.
1,415,700.
Perfect. Excellent. So the answer to question number 1 is 1,415,700. Question number 2. Calculate the budgeted fixed overhead. What's the answer there?
The 1,386,000.
Yes, the one in the center here. So the answer to question number 2 is 1,386,000. And then obviously question 3 is on the left side here, 1,410,000. Question 4, basically the same thing for variable, right? Question number 4, the answer is 818,532. What's 5's answer?
128,900.
The 128,900 for question number 5. And question number 6 is the actual variable overhead. So those are the answers to the questions. So, if you're the manager, of this company, how would you solve the spending variance problem? How would you fix, what things could we fix?
I mean, for this one, though, is it really a matter of fixing the stuff?
Or what would you do?
I mean, because like our variables are gonna be off because we produced 3,000 more than we planned.
But we've accounted for that difference through using actual hours. So that's not causing my variance here. I've accounted for the actual being more. What else causes a spending variance? Either one, variable or fixed.
I mean, like the stuff that we buy, like the quality of
Yeah.
it, it's more.
We gotta talk to purchasing, right? Maybe the buyer is charging us more, right? That could be a possibility. What's another possibility, though? We've talked about it.
Workman's comp,
Training.
if there's been an injury.
I could see that workers' comp being an issue on our labor end. Although it is insurance. I got your point, Teresa. Yes, there could have been
Increase in insurance.
unplanned workers' comp. Let's put that in there, injury. Yep, something unexpected.
Utility bills?
Yeah, utility bills would be under that by or something changed there. We could have left our lights on or left our machines running over the weekend. We didn't want to.
Power outage, maybe?
Possibly. I was thinking this,
Waste.
waste and or right? Waste, maybe theft. Remember, there's a lot of things in this overhead number. Supplies, right?
Yep.
Repair equipment, janitorial supplies. It could be I don't know, what else could there be? All the maintenance stuff, even the grease, the oil on all of our equipment. Again, all that could be causing this unfavorable variance. How about production? How do we do there? How's our capacity? What did we plan to make? How many units? 140. We made, what, 143?
Yeah.
So the plan was 140. We made 143. That's good. That's my smile emoji. Right?
Yeah.
We produced more than what we planned. Again, this is good as long as what we have to be concerned about quality. Are we shipping out product that doesn't meet the standards, right? I know I'm the production manager. I gotta know I gotta hit my 140. I might send out product that might not be quality-wise as good as it should be, right? So that's always a concern. And then finally, this efficiency variance, how do I fix that?
Training.
Training. We're obviously doing something over, right? We're actually spending more hours than what we thought we should. So that's probably the better choice there in that training aspect of it. And the reason I'm going through this, obviously I'm not going to ask you that on the test per se. It's easy to do the templates, but you as a production manager have to use that information. That's what we're trying to solve here. All right, let's take our first break, and we'll continue on. I do want to do one more exercise, part of it anyway, problem 61. Let's take our first break, though. Rather than using our templates, this is a different layout. It's called a performance report. The problem is 1061 on page 574. The sample in the book is on page 547. So it's basically our template in a different format. I'm only going to do the indirect labor. The actual cost is $36,000. And we're going to compare that 36,000 to our budgeted level for the actual hours, and that should give us our spending variance then. So this is just like our template. To get the middle number here, we're going to have to take our standard variable rate times the actual hours. for problem 61 and for indirect labor, what is our SVOR rate?
2640.
Be careful, I only want indirect labor.
Oh,
The 24.
24.
Yeah, so this should be the $24. And then what were our actual hours?
1,409.
1,490. Yep.
So,
And that will equal then how much in dollars?
35,760.
35,760. So that is roughly a $240 difference. That difference is our variance. Sam at home, on the spending variance here, is it favorable or unfavorable? Look again at the numbers. I think it's the other direction. I think I spent more, right? I
Yeah.
spent more than I planned to spend or should have spent. So I think this should be an unfavorable variance. Sam, is that okay? That it's unfavorable? Okay. All right, good. I'm glad it makes sense. So on the test, I could present the information like this also, rather than a template. Anybody else have a question on why it's unfavorable? Okay. Let's look at our third column, right? Budgeted for standard hours. So here, I'm going to take my SVOR times SH. The SVOR stays the same at 24. Let me change colors here. What's my SH? They actually give us the number.
1,500.
The 1,500, right? Oops. Worse I have it, I put a dollar sign in. 1,500 hours. How much is this E?
36,000.
Okay. So my efficiency variance is going to be looking at the difference here between these two cells, which again is 240. It's just coincidence that our applied amount is the same as our actual number. So, but which direction though, E?
Favorable.
Favorable this time. This one's favorable. How'd we get to 1,500? I know they gave us this number.
The 10,000 units produced times 0.15.
Yes. So I really didn't need to give you the 1,500. I could have just said SH. Here are the actual units. Figure it out. 0.15 is what it should take to make 1 unit. 0.15 hours. Where do I use the 2640? If I had my template, I would put it where? The 20? No, it's the variable, right? The 2640 is actually this number. Why did I tell you that it was 24 over here?
Just looking at labor, not supplies.
We're just looking at indirect labor only, and not supplies. Very good, Diane. Remember, over here, this actual overhead is made up of hundreds of items. And we all add them up. All their variable rates are added together, and that's how we get this number. Whereas here, we're looking at them by line item. So that's the difference. So for supplies, right, my SVOR is what?
240.
The 240, if I were just looking at supplies instead of the $24. So very similar to what we're doing, but just a different look as to how to compute the answers. So be ready for both ways. We'll practice this on Wednesday again, but if by chance Liz was just doing her problem and she was hitting this problem as she was before break, so good timing. Liz, your hashtag cool with this now?
Yeah.
Awesome. Did you notice the numbers here? Isn't that freaky? If you like numbers, it's pretty cool. You get it, they're transposed.
Okay.
Okay. I just think that's kind of neat. All right. I gave to you some templates for chapter 14. I can't emphasize enough, if you're going to run your own business or you're working for a company, there's no more important thing than cash flow. It's the one that kept me up at night. Especially if you're a small company. Cash flow is death, death in life. The company profile for chapter 14 is Google.
Oh,
And
they say go big or go home, right?
they are big. If you noticed here, the offering price was $85 back in 2004. By 2009, it was $600 per share. So back in 2004, you should have bought as much Google as you possibly could have, and you'd be retired by now.
I think it's about $1,000.
It's right around 1,000 right now,
Yeah.
so yeah, it's amazing.
Crazy.
But the reason they profile them is that they didn't cash flow, or am I thinking something different? I'm just looking at the numbers, they're just staggering here. They're not in the millions, they're in the billions. So 8 billion, 2 billion to 9 billion. Can you imagine having that much cash on hand in the billions? Incredible.
Buy a small company if they wanted to.
Oh, sure, easy. So the king of all measures is cash, and I totally agree. So just if you get a chance, read that Google article. It's very interesting. And their growth rate has been triple digit. And when you're growing that fast, cash is even harder to keep up with. So something to think about. I always had more cash when our sales were going down than when they were going up. Just due to the timing of it. So we do need a cash flow statement. Now, I know you guys have done these in accounting too. Have you done it in intermediate already?
We do that.
You're probably coming up to it. So we're going to do a very brief overview of it just to keep you in tune with it. Our main purpose here is to do the indirect method. Of computing our cash flow. So we're only going to go up to page 80. I think 802. Nope, 801. So from page 781, or 791, to 801. About 10 pages of chapter 14 are what we're going to cover in our next test here. As we know, we have sources of cash, principal being our net income, our operations, right? We have sources from investing and financing. Our uses of cash, obviously to pay our operating expenses, purchase long-term assets, and then again, financing. So what did most companies do with the big tax refunds that they got? Not all, but the bigger ones did. They used the extra money to buy back their stock. Why would they want to buy back their stock?
EPS.
Yep, earnings per share jumps when you buy back less outstanding shares, correct? So who looks good when their earnings per share goes up?
They do.
Board of directors and
Yeah.
those in charge of that operation. Yep. How the world works. Cash equivalents, cash, treasury stock, mutual funds are all, commercial paper all considered cash because of their liquidity. Operating activities, obviously that's our organization's operations. And so forth. Just know the difference between what's an operating activity versus an investing activity. This is all on page 792. And when we're looking at the investment section, we're looking at the purchase and sale of long-term assets, right? Purchase and sale of long-term assets. Financing is provide cash, right? Interest expenses in the operating section, just know that. Financing is either stock issue or long-term debt. Those are in the financing sections. Stock issuance and purchase, or long-term debt issuance or payoff, basically, is in the financing section. example 1 does a nice job showing some of the things, again, we'll see either in a matching exercise on the test or multiple choice. Example 1 is on page 793. So this one is a good review for us for the test. And you can see you have the transactions first, and then where do those transactions reside on the cash flow statement. So if we issue long-term debt, right, that's in the financing section. It's a source of cash. Or if we reduce our long-term debt, number 5, that also is in the finance section, but on the use of cash. So I did hand out those templates for the cash flow statement. It's the ones, who did I have for, did I have any of you in accounting too? No? Okay. It's the same template that I use in accounting too for cash flow. So please review this page. It's a good one for the test. Let's try 33 as an example here on page 821. And we actually can go around the room here. It's pretty straightforward, I think. So we have to identify what 3 sections. Either operating is 1. Investing is the 2nd. And then finally finance. The finance section. Starting with letter A. Michelle, are you ready?
I would say investing.
Yeah, investing. Source or use?
Source.
So that would be a plus, right? Source of cash would be a plus to our cash. Sold it for $750,000. Diane, reporting a profit of 100. B.
Semi-operating.
Operating. Good. Source or use?
I don't know what you're looking for there.
The word is, keyword is profit. So it's a source of cash, right? I'm getting cash.
Right, but what are you trying to, I don't,
So like whether we're getting money or spending money.
oh, is it inflow or outflow? Is that what we're
Yes.
using?
Inflow, right? Yes. Sorry about that.
Well, I just couldn't figure out what that source thing was, so, thank you.
Should I say inflow? Would that make it?
It's fine. I got it now, so.
Okay. Smiling emoji? I don't know why I'm on that today, but I am. That's a good thing, right? A source. C, DePauli.
Financing.
Yep. Source or use? Retired means pay it off, right? Get rid of it. So then that would be a use, because I'm spending money. It's an outflow. Does that make sense? Got it? So this is our first use one. This will put a negative drain on our cash flow. Liz, letter D. Yep. Source or use?
Use.
Everybody agree? Okay, very good, Liz. Are we on to E? Go ahead, Teresa.
Financing?
Good. And
Source of cash.
when they say mortgage on a new building, what does that mean?
They gave us money.
They gave us money, but a mortgage means it's
Long.
collateral for a building, so the
Yeah.
building's attached to the loan, right? So the bank technically has title over that property. You don't until you release it from the bank. Kershaw purchased new robotic equipment.
Invest.
Source or use?
Use.
Good, excellent. Tom, G?
Financing?
Finance, good. Issue means what?
You're getting money.
Getting money, so it's a source.
Yeah.
Very good. H, E?
Is it financing?
A 40% interest is that we're buying what?
Oh, interest in a company. so
Yeah,
Investing.
investing. Yeah, that's a better one. Source or use?
Source. Use.
All the above.
All the above. Don't you need all the above?
I don't think we're gonna get it all above that.
Your final answer is?
Use.
Yes. Because we're spending money to buy that stock, right? Okay, Sam. I reported a loss for the year. It's kind of like Diane's profit one. So the loss, net income, net loss would go where? Not finance. It is a use. I agree with that. Okay. Not that one either. So it must be what? Operating. Yeah, it's an operating one. If you look at your template, Sam, your cash flow template, we always start with the net income, net loss on the top. So this is the operating section here. If that helps. Hopefully that helps too. So this is an operating section. It is a loss. So that would be a use then. That uses cash out of our operation. Catherine, what's the last one? Negotiated a long-term loan. Yep, finance. Source or use? I'm hoping you said source. Okay, I'm assuming you did. All right, awesome.
So the question,
Oh, use. It's actually a source. We're actually negotiating it to get the money. Diane?
that was kind of my question, should it even be on there if it's negotiating and it's?
Yeah, we're assuming they negotiated and they got it. You're right, though. It's not until we get the money that we actually have it. So,
So are we gonna be tripped up like that?
no,
Yes?
gosh,
Okay.
we're not that
Just
mean.
checking.
I know, I'm not that mean. No. If you put finance and they said it wasn't either, neither a source nor a use, I would have a problem with that. So we're assuming they won it. They got it. All right. So that'll be like a matching kind of thing. Matching activity. Okay, another concept that we have to go through is 34. Remember with the indirect method, net income or net loss does not equal cash, right?
Right.
There are so many things that influence that net income that are not cash related. So what we're going to do now is decide, again, if we look at our template, we're in the operating section. We're right here. We're trying to determine, we're going to adjust this net income and convert it to cash. This is a huge, huge number, this net cash flow from operations. Banks love to see that number. Why is this so important?
What's it?
It's probably more important than the bottom number.
Liquidity?
Well, yeah, it's liquidity, but what does this number tell the bank?
Operation? How much money is in the operating cycle?
How much money you're getting from your
Yeah.
business, right?
Mm-hmm.
From your sales of your product or your service that you're providing to your customers. Are you able to make money on it? And is it adequate enough to pay back the loan that you're going to get from the bank? That number is huge. So we could have, is it possible to have a net income and yet have a negative cash flow from the operation? Oh, yes, certainly. Certainly could. Especially if your sales are ramping up rather quickly, you have a lot of income because you record the sale when it's what? Earned. It's not when you get the money. So you could have a huge problem on the cash end of things. So that's the section we're looking at, this operating section. And it's also problem 2 or 3. So let's just take, I think if we do some problems, I think you'll get it, because you've done these before. Ruby, since we didn't get you on the first round, is this going to be added to or deducted from net income? A gain on sale. Letter A. Gain on sale. What would you think? Do we add that to net income or do we subtract? Yeah, gain is in most cases a good thing. We would add a gain. But remember, a gain does not mean cash. A gain means we've earned that, true, but did we get the money? And that's a no. So in this case, subtract, right? We have to subtract. So you almost have to think opposite on this particular one. So this was, remember where we're coming from. We're starting with net income. We're subtracting it out to get the gain out of there, because that's a non-cash item. It's a non-cash item, so we got to get it out. We're starting with net income. We're going to reverse it out. right, Michelle, you're next. Increase in accounts receivable.
So I just added, doesn't it? I don't know, I'm confused on what I'm doing right here.
It's actually subtract. Let's do this. This is not working.
So here's.
Go ahead. Go ahead, Diane.
Assets, you always do the opposite of what the line item tells you. So if it's an increase in accounts receivable, you do the opposite and you decrease it from cash, or from that income.
From net income.
For liabilities, you do exactly what they're saying.
Correct.
So increase, you add, if it's decreased to.
Yes. Correct, Diane. So what Diane is saying, I'm just going to put it on here. Assets, gains, right? If the assets or gains are increasing, we subtract. If the assets and gains, which would be a loss, we add to reverse out the effect. All we're trying to do is convert that net income number to a cash number. With liabilities, it's the same direction. So if the liabilities are going up, we add. If the liabilities are coming down, we subtract. Correct.
Okay, I get it now.
So if you got that little note, that helps, that will help on the test as to which direction. So we can put losses over here, right? You add if you have a loss. You subtract if you have a gain. All right. Let's try C, Diane. Pardon?
And
Add. It's a decrease in an asset. Think about it. A decrease in an asset. It's called prepaid insurance. So my journal entry is to what? Credit that and debit the expense, which reduces profit. But it's a non-cash entry, so I gotta add it. If you can think that way. Amortization expense to Polly. Add. What's another, oh, it's on the end, so I won't worry about it. Liz, increase in accounts payable. Excellent. Think about it again. Accounts payable is going up. Am I spending cash? Nope. It's on credit, right? So that's good. So add it back. Uncollectible account expense, Teresa.
Add.
Good. Kershaw, decrease in wages payable.
Subtract.
Yep. Tom, what's the next one?
Subtract.
What are we doing?
Increase in inventory. You're spending money for inventory.
Yeah, that helps. That hurts our cash flow. E, last one.
I'm thinking add or subtract.
Come on. Yeah.
Think about
Add.
or subtract.
We
Well,
certainly
there
would.
was a pause there, so like I wasn't sure.
Yep. It's expense. Depreciation expense is debited. Accumulated is credited, right? I had one of my fourth semester students get that entry wrong. That should never happen. Debit the expense, credit accumulated depreciation, right? Very good. let's just get started on one template. I gave them out. I gotta do one. 36. This is the indirect method. It's the easiest method. I've been in accounting for 30 plus years. I've never seen the direct. So the indirect is the most common one used. So that's why we practice it. We start out with 61,725 of profit. That's given to us. And then we have a list of what type of an accounts are we looking at here? What is AR, accounts receivable, inventory, prepaid, accumulated, accounts payable, wages payable?
Those are operating.
Those are all operating, or more specifically, other than the accumulated, current, right? So we're only looking at the current assets, current liabilities section here. But that means, why is the accumulated, what section does the accumulated depreciation on the balance sheet, what section does that go into? It's not current, it's what?
The top one, reconcile,
It's what?
on the top section.
Yes, but we don't call it accumulated depreciation here in the adjustment section. What do we call it?
Depreciation.
Yes. So that's why they have that in the list, that accumulated. So it went up, right? So he must have incurred depreciation expense of how much? Excellent. Do we add or subtract?
Yeah.
Very good. It's a non-cash expense, right? Remember that journal entry is reducing my income. I'm reversing that effect. So I'm starting out with a non-cash 61,725. The goal here is to get it converted to a cash number. All right, that's the only non-cash flow activity here in this particular problem. So now we can go down to the other current assets, starting with accounts receivable. And accounts receivable did what? Go up or down? It went up. So what do I do with this increase? Do I add or subtract? Subtract. Very good. So I'm going to be subtracting here. The difference is 12,250? Nope. 22,250? Nope. How about 32,250?
Yes.
That's the final one? Subtract. Inventory is next. Also went up. So here again, we're going to subtract. What's the difference here?
16,500.
16,500. Prepaid expenses also went up. We're not doing good here. That's an increase.
$3,000.
3,000. Okay. Accumulated depreciation is not a current asset or liability. Go down to accounts payable. What did that do?
Increased.
That increased. So is that good for cash or bad for cash? If my accounts payable goes up. That's good for cash, right? I'm borrowing from my vendors, correct? Basically. So I'm going to be adding that. The difference is 10,125.
Yes.
And then our last one is wages payable. That went down.
Yep.
Is that good for cash or bad for cash?
Bad.
That's bad. I'm not borrowing from my employees anymore. I had to pay them, right? And that difference is 12,000. Okay. So starting out with net income at 61,725. I add the depreciation expense. And what do I end up with here? Is it positive?
18,600.
I knew it was close. Okay, so it's a positive cash flow, but not too close for me. That's too small. Because again, timing is so critical here. I could be short in a particular week when I'm paying some wages and buying inventory, right? Where I could be running out of cash in a certain week. I mean, we're looking at a period of time, normally a month. I don't know what's beginning and ending of the year. All right, but for the year, that is a small number, extremely small. So most people will have available line of credit for their business, right? So if they do run in a short week where they don't have enough cash to pay their employees, they can borrow against the line of credit without any questions or having to fill out a big proposal or questionnaire thing. All right. I'm going to stop here at this point. We got a good start on chapter 14. It's more of a process of practicing those problems. I'm not too worried about terminology and such. In 14, we've done these before, so we will practice on Wednesday more of chapter 14 because they do get trickier, obviously, and so that's what we're going to be doing on Wednesday. Next week, Monday, will be a final review of 10 and 14. We will have time available on Monday of next week also to work on any segregated materials. The rest of the class is yours, guys.